Hey guys, how's it going? I'm Gabby. I'm a reporter for Banking Dive. Here today with Sean Neville, co-founder of Circle, creator of the USDC coin, and co-founder of Catena Labs, an AI native bank. So I'd like to start out by, thanks for coming today.
Yeah, thanks for having me.
Let's
fun.
start, so you created USDC stablecoins, which have quite a bit of the market share, and the infrastructure for Catena Labs leans heavily on stablecoins. So why do you think that stablecoins are so critical for making agentic finance viable?
Yeah, well, there were several people involved in bringing USDC to market, so it certainly wasn't a solo effort. But have found on the AI side that stablecoins are effectively AI native money. If an AI actor is making a payment, it doesn't make a lot of sense for it to have a physical credit card. It makes a lot of sense for it to have money that moves at internet speed, that is effectively machine money. It's helpful that they also pass borders nearly instantly at very low fees, but it turns out it's just a much more reliable way to execute payments when AI actors are the ones that are making the payments.
Okay, you mentioned that it's much lower fees when you have stable coins and AI actors. Do you have an idea of how much lower the fees are in that realm versus the structure we have now?
So it varies by underlying blockchain. So stablecoin is a dollar, in the US dollar stablecoin case. It's a digital dollar, and it runs on top of blockchain rails. And those underlying rails have different fee structures. They're built a little bit differently. USDC, for example, runs on, I think, something like 21 chains and counting. So it can run on many different rails. Some of the cheapest rails can be fractions of pennies to move trillions of dollars nearly instantly, which is something that we've just never seen before. Of course, we have seen it when it comes to data and content on the internet, but we haven't yet seen it with money that runs at internet speed.
So you've described the vision for Catena Labs as an AI native bank. Can you explain what that actually means and how it's different structurally from a traditional bank or FI?
Yeah, in many ways it's an extension of what we started to build with stablecoins. In the sense that the vision there was to enable broader access to the global monetary system, open up new kinds of opportunities and business models for people everywhere who could access money on internet rails. Well, now what we're seeing is that many of the actors that are executing transactions could be payments, could be remittance style payments, but also could be credit, lending, treasury management, FX, and so on. Many of those workflows that are executing those activities are enabled by some form of large language model, data parsing and decision making, and increasingly the conviction is that AI actors will be dominating transaction activity globally over the next several years. And so those two things tend to fit very nicely together. They're accelerants for both, for each other, in the sense that the dollar is kind of going internet native, but also the internet now is going agent native. And so at Catena, we're very much focused on realizing that vision, which means ultimately, we think our customers for this new kind of bank will be AI actors. As science fiction as that sounds in the future. If an AI actor is making payments, well, it needs to get paid, it needs to be able to manage assets effectively, it needs to handle effects, it needs to negotiate, may want to get yield on the holdings that it has. And so what kind of financial operating system is necessary to enable an AI actor to do that? We're building it. We're also building it internally as a bank with the typical compliance and risk sort of infrastructure that you would expect, but we're doing it all natively with AI. So our compliance workflows are built with AI workflows. Our software is developed by AI workflows and so on. So it's both internally AI and ultimately will be for AI actors as well.
So if the customers are primarily going to be AI actors, are they all AI actors doing the business for real people? Is that the idea of that?
So our focus first is on businesses, but it could also be people. You will have probably a number of AI actors that are hyper-personalized to you, Gabby, and they will do all kinds of activities to the extent that they're executing your banking and transactional activities. They will be managing your funds, and we do believe that at some point, and not today, we're very early stages, but at some point, they'll be the only actors that you trust with your money. It'll be the only competitive way to earn a yield on your returns. And so we believe you and everyone will ultimately lean on our own AI actors. I think where we first see it though is not in the consumer realm, it's more in the business realm. And that's our focus as well.
What do you mean by that?
So the first actors in workflows that will be executing payment flows are likely to be found in things like supply chains, helping import-export businesses, paying out to humans, so B2B2C sort of scenarios. Businesses are already beginning to automate their workflows with large language models involved in decision making, so it's a natural step for them to also be included in executing the actual transactions.
So, legacy financial rails weren't built to handle AI, agent identity, or trust. So to enable true agent-to-agent finance, we need a new infrastructure layer, right?
We largely
how does
do.
How does that work? How are you approaching that?
So you take a typical payment processor risk scoring piece of infrastructure that is designed to do things like when your credit card is used in a transaction, make sure that it's really you, that it's not your card hasn't been stolen, that it's not being used in a scenario that seems suspicious. Well, it turns out all the risk infrastructure that we've designed to date is mostly designed to keep bots, early AI actors, out of the system. All bots are bad. Must be a KYC'd individual or a KYB'd business, and what we really need is kind of the other way around. Let's just assume that bots are going to be transacting. Let's assume that maybe in the future bots are the only actors that are transacting. How do we keep out the bad bots, but how do we allow access to the good AI agents, the good bots, and how do we give them policies and guardrails that constrain what they're allowed to do with our permission, aligned with our interests? And that risk infrastructure doesn't exist, and we need to build it as an industry in order to enable this, this next era of agentic finance.
Who do you suppose is going to be, so that would be like a KYA, right? Like
KYA, yes, exactly,
know your agent. So how do you see that?
The other thing I've heard is human not present transactions.
Okay.
So, yeah.
How do you see that being built? Like where do you think that is going to come from?
So ideally, in my mind, that's a foundational element that we can all build on top of as an interoperable standard. In the same way that, if we go build an e-commerce web store, well, SSL exists, HTTPS exists, the little lock in your browser, it's just a standard no one owns. Microsoft doesn't own it. Google doesn't own it. It's just a standard. Similarly, we'd like to see some foundational standards for agentic identity and agentic workflows that touch finance. That doesn't exist yet. It's such early days. There are many different sort of takes on what this should look like, some from incumbents, some from new ventures, but our interest is trying to pull some of these together so that we can have a united foundation to say, for everyone, here's some common patterns and here's an interoperable, at least de facto standard as a start that we can all build on top of.
Mm-hmm. So if this structure doesn't really exist yet, what made you want to build a bank for these, I don't know how many millions, billions of agents that you suppose are going to be existing and dealing transactions?
Yes, well we certainly have to contribute to those foundational elements. It's very similar to working in the early days of the web. When we were building our first companies, we needed to contribute to web standards because they didn't exist. And way back in the early days of the web, there were online services where you could do versions of commerce. We could send each other emails if we were all on America Online, but we couldn't yet do it in an interoperable way on the internet because SMTP, which is an email standard, didn't yet exist in a broad way. And so the early web companies needed to contribute to building those foundational standards, even while they were also thinking of the commercial products that they would build on top. And so very similarly today with AI, we'll continue to contribute to the standards development and devote resources, engineering resources, and other resources to it, while also thinking about building our commercial product, which is related to this new kind of financial institution on top of the foundation.
So when you're building something so early on in in its existence, do you feel like you have to be a lot more cooperative with the other people or the other entities in the ecosystem than you do when it's already existed for a long time? I
think it depends on the project and the venture. Certainly we felt that way with stablecoins. And I wrote the white paper, the USDC white paper in 2017, ultimately decided to bring it to market with a partner, which was Coinbase at the time. And we also made a strong commitment to partnering with regulators to sort of educate them on what it looks like to have a digital dollar on internet rails. It couldn't have just been a circle thing. It needed to unite several of these other kinds of partnerships on the regulatory side, banking side, distribution such as Coinbase and so on and so forth. It doesn't necessarily take a consortium of 100 parties, but it does take key people cooperating, and part of the work is bringing together those people who don't always like to sit at the same table and communicate.
Okay. We're about to wrap up, but just quickly, what's it been like to watch this company that you built and this technology that you built actually grow into something that's, I mean, it's obviously it's a big conversation here, stablecoins, Circle's now a public company.
Well, it still feels early, believe it or not. So, Jeremy, my co-founder, and I started Circle in 2013. So we're almost, close to 13 years into it now. There has been developments, and yet it still feels kind of early. It is gratifying to finally have regulatory clarity on what a dollar on blockchain rails is in terms of getting the US government's stamp of approval through the Genius Act. It's very gratifying to see that regulatory hurdle at least defined. But we have other hurdles to clear before we really realize the full vision. And it is helpful to see the additional transparency that comes about by doing it as a public company.
Okay, well, thank you so much for your time today. This has been a great conversation, and I look forward to seeing you around for the rest of the show.
Yeah, thanks for having me.